Welcome back, everyone. Today, I want to talk about what I think is a very serious topic for your investment portfolio, and that's whether or not stocks or real estate will be the best performing asset over the next 5 years. Let's get started. Welcome back, everyone. So if you haven't been watching the news, there's just so much going on in the news, whether it be new IPOs, whether it be the SPAC market, whether it be the EV market or Bitcoin, real estate hitting all-time highs in terms of appreciation rates. There's a lot of movement in the market. There's a lot of capital in the market floating around. There's a $1.9 trillion stimulus, almost 3 times what Obama passed back in 2008, coming to the market. There is a massive infrastructure bill, an infrastructure plan to rebuild all of that. People are migrating across the nation. There is a lot going on. And so I want to break it down for you all as to what this means for how you pivot your dollars and make the wisest moves with your investment choices. Let's take the stock market first, okay? And we'll get into some detail here. And later, I'm going to be interviewing my good friend, Jonathan. He's a CFA that manages over $1 billion in assets. And he and I often get together, have drinks, and just totally nerd out on what we see happening in the markets. And there's a big change that has happened, okay? And the big change is that traditional ways of trying to measure value in the market are gone, right? The idea of the common ratios of the PEG ratio and PE ratio, and price to book, the traditional fundamental concepts that once made Peter Lynch famous, that Warren Buffett has used for so long, they exist, but the modern day markets are not using those processes, right? There's new things such as measuring enterprise value, right? So companies such as Salesforce, for example, do not make a profit. They are measured on a multiple of their top line, based upon comparables of other competitors, and the price per share is based off that, right? And this is a phenomenon that's been happening for some time. The VC firms have really driven this practice, but now it's hitting the main street, Wall Street, and valuation techniques are changing with it, okay? And so I say this because I've always been a value investor. I've always tried to find the best values versus the amount of growth in a company. And if there were some dividends that I would get for it, that was a bonus. That's all changed. And I have been pushing hard on the idea of how innovation and how the new technology companies will drive substantial opportunities across all sectors. Cathie Woods, who I am a huge fan of, is all about this. And in this video, I'll include a report to her Big Ideas report. It's a 120-page document about what innovation is doing to the markets, how it's changing the markets. And so check that out. It's a good read, okay? But ultimately, what we're seeing is a few things. There's a lot of capital flowing into the market, and with it, you would assume there would be inflation, right? There's a great article recently out of The Economist that talks to the fact that we probably won't see much inflation as we expected. And one of the key reasons for that is that innovation in new companies are creating deflationary pressures. And what that means is they're reducing the cost of operating expenses for companies, which allows them to reduce prices to remain more competitive, right? That's just one thing. So how we use the internet, globalization, right? The fact that we can use data analytics to drive down or be more efficient with our marketing spend, for example. There's a lot of these companies that are creating efficiencies in the market that have massive deflationary pressures that are offsetting inflation, okay? So while we're getting a lot of capital in the markets, we're also seeing a lot of deflation in the markets offset that, okay? So now this is a lot of mumble jumble. What does it all mean? Well, when you look at what's happening in the market, the stock market, the companies, we are going to see innovation levels that are 5x times any other period in our history. This means if you're picking the right companies, if you're picking the right stocks that are in innovation, that are the disruptive technologies, you're likely going to see massive gains in those stock picks. Now, if you watch any of my videos, I'm an avid real estate investor, and I've loved real estate for some time. I'm still bullish on real estate for the long haul, but I hate to say it, I believe real estate will be a lagger relative to stocks eventually. I do think real estate is going to outperform stocks through 2023, potentially 2024, at which point the point of critical mass for the innovation technology companies and their stocks and values will begin to exponentially outpace real estate. And so what am I doing? Well, I continue to invest in a variety of asset classes. I always say you got to diversify against risk. So I'm continuing to produce or invest in income producing assets, which is the key to wealth. So private money lending, you got to put a portion of your portfolio into private money lending to produce cash flow to fund the other investments, right? That's a foundational item that you must have in your portfolio. And people are not going to stop buying real estate. So you put yourself in good deals that results in 17 to 20% returns on your money to provide cash flow. That will fund the investments in stocks, as well as giving you the ability to pick up properties across the market. So number 2, stocks. You do have to be investing in stocks, but be careful here. This is my recommendation. I'm investing in innovative new company stocks that have disruptive technologies, right? So genomes, automation, robotics, EV, fintech, healthcare, things that are going to change the landscape of our day-to-day lives, right? And again, I'll put the Kathy Woods video here above if you want to see what this is all about. 3, still buying real estate, but I'm not just buying any real estate. I'm not just buying any cash flowing property. I'm buying properties that are in stable markets, healthy markets that have proven to be consistent, that still offer me a 7 to 12% cash on cash return, but also with some upside on appreciation, right? And as sexy as it sounds to invest in Austin or invest in Seattle or invest in Denver, the numbers don't make sense. Do not be buying upside down properties in this market. Okay, there are ways to buy, and you buy in the price points of 175 to 275, and you make sure that they cash flow after all expenses. Okay, so long story short, you have to be investing in stocks that are based in disruptive technologies. That they will be the winner through the next 9 to 10 years of our lives, without a doubt. You have to be, by all means, you have to be investing in private money loans or some sort of income producing assets that provide you cash flow so that you can keep reinvesting. And 3, continue to invest in real estate rentals in markets that are stable and that have been stable with diverse economies and that will slightly appreciate, but also produce cash flow. So if you like what you heard, give it a thumbs up and subscribe. And if you don't, then tell me, help us understand what you're doing to ensure that you make substantial returns over the next decade. Thanks.